Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day, how you going? Welcome to the Smart Property Investment Show. Pleasure as you join us as we navigate property. You've been tuning in. Lots of investor stories recently, and they're the stuff I really enjoyed doing, telling these stories. And I've just been confirmed once again that my colleague here, Thomas Gilmore, is going to share his story. He's in the studio. He's listening to this right now, smiling, sweating a little bit in his brow, knowing that he's about to jump up and invest in property the first time, and he's going to show warts and all the mistakes that he's going to make as he embarks on this particular journey. But hopefully, I know he's a big advocate and listener to the Smart Property Investment Show, and he has been, and our objective here is to make sure that we can make more informed property investors so they can learn from all the mistakes made by others so they can actually maximise their journey through wealth creation. So wait for it. He's been a bit cagey. You might have heard him on the podcast beforehand about when exactly he's going to start investing. So I'll pin him down at some point and report back exactly when that's going to happen. So watch this space. It's all going to go on. And if you're listening to this and you want to come and have a chat with us, you're more than welcome, whether you got no properties, one property or 50 properties. Come and share your story for this growing community of property investors. You can email the team, editor at smartpropertyinvestment.com.au, or send us a direct message on the social stuff, Smart Property HQ. Moving right along, we're moving into some data land today, and we like covering data here at Momentum Media at Smart Property Investment. It's a very important part of being a more holistic property investor. As you know, and as a preamble, if you've been tuning in before, data is not the be-all, end-all, but is a very big part of it. It gives you clues. It can help set your strategy, but you need to be doing it in conjunction with what is actually happening on the ground. Now, the biggest issues with data, and whether that's price data, economic data, job growth data, all the different moving parts that can help determine how you approach investing, is that it confuses most property investors, particular sort of macroeconomic data. Everyone talks about fundamentals, and how fundamentals will change and shape the way in which you invest in property, but most people aren't really too sure what those fundamentals are. They get confused with them, or they have some particular bias towards them. So I want to get into today sort of macro level data. You know, at times Australia has a very strong property market and a lot leaner in other periods. It's going left, right, up, down. No one really knows what's going on. I bury my head in data a lot when it comes to the Smart Property Investment Show, so I can be more informed about it. But I am conscious that I am not an expert. In the studio with me today is one of those experts. I like to think he is. Propertyology Head of Research and REIA Hall of Famer, Simon Pressley. I didn't know you were REIA Hall of Famer. What's the Hall of Famer in the REIA? That's a Real Estate Institute of Australia.
It is. So there's obviously 8 states and territories. Yeah. They're members. So there's an REI NSW, an REIV, etc. Each year, each state and territory has what they call an awards for excellence. Okay. And there's about 20 different real estate categories, from auctioneers to sales agents. One of those is buyers agents. It's several years ago now, show my age, but had 3 consecutive years as Queensland's Buyers Agent of the Year. And
that's pretty good.
That then went on to 3 National Buyers Agents of the Year, which is an induction into the Hall of Fame. So,
but yeah, I think Buyers Agent's a bit of a catch-all for anyone that supports investors to locate and source investments, but buyers agents is a lot more than that. We speak about it a lot. Simon's back in the show. He comes and sees us sort of every other month down from Brizzy, and we do appreciate him coming in. We normally have a lot of fun. He's my most prepared guest on the podcast, and he always comes in and throws me some curveballs. So I've been a bit proactive this time, and I've asked him what I wanted to chat about, but he's been a bit suspenseful with this particular chat. And we're going to look at the top 10 market influences. So these are the things that shape the way in which property moves, whether it's up, down, left or right. And you haven't told me what they are. So you're going to keep me in the dark.
I will surprise you as much as the audience.
Are you testing me? Are you?
No, not at all.
No, you sure?
Not at all.
You're going to give me a pop quiz after this conversation. But, we've got a graph here in front of us, and I'll try and paint the picture for those of you. It's obviously an audio thing, but it's pretty much just a curve that goes up or down over a period of a couple of decades. So 30 years, starting way back when. And I'm happy to report that most of the movement is above the line, as in positive growth. There is some negative bits, but it really shows how property in Australia does fluctuate as a national collective. We're not talking about individual states, but this is also breaking down the state movements. But a lot of it sort of operates in parallel. So there's been a lot of movement in property over the last 30 years, and there will continue to be a big movement in property over the next 30 years and into the future. If you go back to when the first fleet arrived, there's different prices of different property, right? So what we need to do, Simon, is make some sense about what's behind these changes. So these are the top 10 market influences. And rather than starting at number 1, the most important one, I want you to start at number 10.
Yeah, number 10.
What is the 10th most market influence? And just as a, we're going to go through some numbers here and some economic theories and principles. If you're tuning into this, Simon, and you're listening to this going, okay, that's all well and good, how should you be framing yourself as we embark on this conversation? Is it about just be aware of this stuff?
Yeah. So before we get into what the 10 are, yeah, good point, bit of a preamble for the audience. Some of these things will just happen and they'll affect the entire country. And as an investor, there is absolutely nothing that you can do about it. Sometimes these things will be good, such as interest rates dropping 3 times in 5 months late last year. That's not a researchable thing, but understanding is that going to have a positive or negative impact on property markets in a broad sense. So, yeah, some of these factors you can do nothing about, and others will be researchable when you drill down from a location to location point of view. Some of these factors can have a very positive impact on property markets, and some will have a negative impact. So number 10, in terms of the most or biggest influence on property markets, is exchange rates. We cannot do anything about them, but exchange rates certainly do affect the national economy and particularly our export sector. So if we think of things such as international tourists, if we think, which is a massive market, I was just reading today, $40 billion of Australian turnover is in our tourism sector alone.
This is the big problem they've got right now when you look at it contextually in this conversation.
Absolutely.
Bushfires, right? It's got an impact. So by exchange rates, you're talking about the
Aussie dollar.
Different value of money compared to buying and selling the
Correct.
Aussie dollar.
Yeah. So think of Australia as a big shop. We've got all this stuff that other customers, other countries around the world from time to time might want to buy, whether it's our mining commodities, whether it's coal or whether it's the shiny stuff, gold and lead and zinc, whether it's our agricultural products, whether it's our tertiary education services. Lots of international students come not just to our capital cities but all over Australia to study. Tourism markets, as I said. So the exchange rate affects lots of individual economies there. When the exchange rate is favourable, those industry sectors will be performing well, local economies will be strong, local confidence will be strong, more people will transact in property, and it works the same the other way around. So you can't control exchange rates, but understanding how it does have an influence.
And again, like the property market, it ebbs and flows depending on what's happening globally and what might be happening in Australia. And there's a whole bunch of things that influence exchange rates way outside the scope of this particular podcast. But sometimes it's good for Australians to be spending the Aussie dollar somewhere else in the world, and sometimes it's better for people to be buying stuff in Australia from other parts of the world. Can't control it. Be aware of it. So how connected do you need to be with exchange rates? Like, you don't need to go and look up xe.com and see what the exchange rate is any given time.
I'd be lying if I said I'm engrossed in what the Aussie dollar's doing from day to day. I'm not. I don't care.
Yeah.
But when there's a significant movement over, say, a 12-month period of time, and if that trend is likely to follow, yes, we then zone into, is this going to affect what industries in a positive way or a negative way, and then drill down to which towns and cities in Australia rely on that particular industry sector. And that can be a leading indicator to stay away from that market. So there could be some markets that are actually performing strongly at that point in time, but a change in an exchange rate, if it's likely to have an adverse impact on a local industry sector, will be a cue to us to just back off.
And it also connects in with competition in the market when it comes to property. If it's a good time to spend your offshore dollars in Australia, you'll see a lot of people coming in and hoovering up a lot of off-the-plan type properties, which can really shake property markets. So
that's a good example.
Be aware.
Yeah, the Sydney and Melbourne boom, initially, when it started sort of very late 2012, initially it was the international investors that started that. The exchange rate was favourable for them, and there was millions and millions of people who wanted to get some money out of big parts of Asia. And to them, Sydney and Melbourne is Australia. So when the exchange rate was favourable for them, they're buying up all these properties. So extra transactions in the property sector, in this case in Sydney and Melbourne, got their momentum moving along, which for the few years before that, the market was quite flat.
Supply and demand, and that resets price points in those markets. Number 9, Simon, top of the top 10 market influences.
Number 9 is a subjective thing because all humans have different emotions, but it's actually lifestyle. Lifestyle affects things like internal migration. if people get en masse, get sick of things like congestion, safe neighbourhoods, they can move away from certain locations. How does this show up in data? Internal migration data is something that, of all the different things to do with population growth, the internal migration data is the stuff that we have most interest in. It shows where people are moving to and where people are moving away from.
And some of that narrative now is around sort of sea change, tree change, and people heading up from Sydney and Melbourne up north to your neck of the woods, sort of Brizzy and some of those areas up there, where this perceived idea of affordability is much better, and therefore their lifestyle decisions to change and shape your futures in another state where you might have a few more bucks in your back pocket or increase your standard of living.
Yeah. What needs to be kept in mind, though, for an investor is what constitutes a good lifestyle to you is important to you and where you live. But you should never invest like that, because you're not living in the property. What constitutes a good lifestyle to someone else, you may not like. So it's really important that we keep emotions in check. But I think demographics have changed as technology's changed over the sort of the last generation. High-speed NBN. We've got great airport infrastructure, not just in capital cities, but right throughout large parts of regional Australia where people can get a direct flight within an hour from A to B. And this is showing up, again, in data, in internal migration trends, when people are sort of saying, well, I can't afford to live in that city, or I don't like the 2 hours I'm spending a day in a car. So what other options have I got? Now, they might still need to come back to wherever that location is, but knowing that it's a 1 hour flight and with high-speed internet, they're connected to the world 24/7, cable TV and all these sort of things that previous generations didn't have.
Number 8.
Number 8 is housing affordability. Again, it showed up a lot during a couple of years ago, during the Sydney and Melbourne boom, more towards the back end of that. We started to see a big shift in internal migration away from expensive cities into more affordable locations. But it can also affect market downturns. Basic logic, the more expensive something is, when there's a downturn, the further it can fall. When something is relatively affordable, it will also have a downturn at some point as well, but there's further for it to fall. And the other thing I think affordability affects is first home buyer incentives. Yeah. When markets start going through that and prices are increasing at a rapid rate, often state governments will say, well, now's the time to throw out a stamp duty concession or, something like that to help someone get into the market there.
Well, it's a highly politicised housing affordability. There's a number of different mechanisms, whether it's state or federal. Yep. At a state level, it'll be like a OCR, so the state stamp duty type stuff. At a federal level, they might mandate some changes, or it might help in terms of sculpting the way in which lenders might be able to be a bit more flexible in the products they create for first-home buyers or whatever it is. But it's highly politicised, and you see these things going through in cycles. A couple of years ago, everyone was talking about housing affordability now is okay in Sydney. No one's really banging a drum about it because property's dropped a bit. But if you go back through time, all the way back to our parents' generations and their parents' generations, you can pick up a paper, and I've seen it because I did a renovation once and there was some papers under the floorboard and it was talking about how it's impossible to buy the first home in the 60s.
Yeah.
It's there and it always will be. Just be careful with it because it can change the way in which people do invest in property, and it may also manipulate or influence markets in a particular way where you have big first home buyer activities. It can reset price points, much like when you have foreign investment coming in and particular assets they're buying at. So it can skew the numbers.
I think in Australian history, the best example of housing affordability and government incentives was at the turn of the century. Those who can remember, we introduced probably our biggest national tax reform. We introduced the GST in the year 2000. And in doing that, that meant that when someone buys a house, they've got a brand new house, they're going to pay an extra 10% overnight because the cost of all the goods and services added to that. So in launching the GST, we introduced, remember it was a 3-level first home buyer grant. There was a $7,000 grant, there was a 14 grand, and there was a 21 grand grant. Now that's a reasonable amount of money today. 20 years ago, that was an enormous amount of money.
It got people into the market.
Huge. And the single most lucrative year in Australian real estate history was a few years after that.
When everyone was in there buying their first homes.
Now, the first time a homeowner grant alone did not cause that. And no one thing causes that with the market. But it certainly did contribute to that.
We're going to go to number 7, Simon. But beforehand, just go to a quick break. Back in a moment.
If you're a regular listener to the Smart Property Investment Show, then odds are you're already a property fanatic who loves hearing stories on investing from real people, the good, the bad and the ugly. Be with people just like you and join the group Passionate Property Investors on Facebook now. Become part of a community who know what to do and when to do it. And the time to do it is now. Passionate Property Investors. Tribe, tools and tips. Find us on Facebook today.
Welcome back, everyone. Here with Simon Pressley, Propertyology, Head of Research, top 10 market influences that shape, change, manipulate, manoeuvre property prices in Australia. We're at number 7. Simon, I have no idea what these are going to be. So these are all surprises to me. And you put me on the spot because I'm supposed to speak with some level of authority on these points and I have no idea what they're going to be. So for our listeners, you could tell I'm just trying to make it up as I go along. But it's really, I like doing it this way because, you just get immediate sort of response to things, like the narrative around it. And all of these here are key influences. And I'm quite interested to know what your number, and these are in order, right?
Yes.
These are in order. Okay. So you're saying house affordability is more important than lifestyle, which is more important than exchange rate. So we're going to get to number 1. Okay. Number 7.
Housing affordability, if you can't afford it, you can't have it.
Don't say that.
The key part
you just use Afterpay, don't you, for it?
The key part of demand for anything is not the desire that we think it is, where we sort of say, I want that. If you can't afford it, there is zero demand. We can just sit back and admire it, but you can't have it.
Yeah. Number 7.
Number 7 is, and as you correctly said in the intro, Phil, not everything is in data, and here's an example of it. Consumer confidence. It has a significant impact on property markets, but it's not something that you can point to a number in a spreadsheet. It is a mood within a community. And there's a couple of consumer confidence indexes that a couple of the banks run and a business confidence index, but it's not really useful for a property investor because it's Australia's consumer confidence index did this. Well, how's that going to help you invest?
Yeah.
It's not. How's that tell you what's happening in Sydney or Melbourne or Brisbane or wherever? But it's the consumer confidence is the lunchroom discussion. It's the barbecue discussion. It's all the things that influence the tone of that discussion. If we're concerned about something significantly about the broader national economy or our local economy, that will flow through to those lunchroom and barbecue discussions. Now, because property is arguably the most expensive thing we ever have to buy, and before we buy the asset, we must buy the not so sexy bit. We've got to buy the debt. And so confidence affects the psyche of buyer behaviour in a really, really big way. Not many people who are feeling scared and worried and concerned about whatever the cause is are going to rush out and go and see their broker and go into more debt. But confidence, good or bad, it tends to create momentum and it can be a really, really powerful thing. Confidence can cause what might have started out as a mild downturn into a really, really big one if the fear gets big enough. But it'll also, in times of booms, it can be an enormous wave of confidence, that fear of missing out. And
it's very dangerous. And I'm conscious about this in my role within Momentum Media and Smart Property. Momentum Media, the big parent company above Smart Property Investment, and my job, one of them is sort of head of content, right? So, it's my determination of how we choose to approach delivering content to all the markets right across Australia, which can help change the way in which people think about what the future may hold. So, this is the media, and media has a big part to play in consumer confidence. Where they choose a particular focus, their energy intention can shape behaviour or shape attitudes, which therefore shape behaviour. So I'm really conscious about this. But consumer confidence is a very unique thing. It's your lens of the world and how you feel at any given time. And that can be shaped by how your personal life is and how your personal finances are and where you may see opportunities. But it can change overnight. And we saw it twice last year, just speaking off the cuff. One was the election. Running up to the election, everyone had their head in their hands going, it's shit to be in Australia at the moment, right? And then as soon as that election happened and Australia had some certainty of what the world was going to look like for them, and they know that it's mandated by the current sitting government that the Prime Minister that we chose then is the Prime Minister that we're going to have for the next period of time. We're not going to shop down change. So that just little layers of certainty can shape consumer confidence. I speak to a lot of investors, a lot of buyers agents, some very good ones like you, Simon. And it's part of the work they do when they're looking, they might have identified a particular location. I'm sure you do the same. They actually go to the shopping centre where they're thinking of buying and they'll see the demeanour of people. Are they walking up with their heads held high?
Yeah.
Or are they slumped and looking like, flustered and angry? That is consumer confidence.
Absolutely. And at a macro level, it's things that affect it include federal and state elections, what both parties are throwing out about what they're going to do or what they're not going to do.
Policy,
Proposals to change taxes, reduce or increase, can affect positive and negative moods. I think they're the main things, and politicians have such a big influence on property markets, not just by what they do, but what they say or what they propose to do. And you've given the best example there, Phil, in 2019. It was a year of two halves. I can't recall a time when there was more negativity and more concern than the first half of 2019, and then we ended 2019 with this big steam of momentum to take into
which is great. And the other thing of last year, one was the election, the other one was interest rate cuts. But what really changed people's perceptions towards their economic or their wealth future was the Hayne Royal Commission as well. When those were handed down, there's a lot of people just went, the world sucks. The banking sector is gone. Yeah. Right. Geez, we've moved on from that now.
At a local level, though, at an individual town and city level, confidence can be so different. I'll get to these communities. There's very few places in Australia I haven't been to. And what you see when you get there, and the mood can be completely different to other parts of the country.
Well, it can change overnight. If you get a big bucket of rain in some of these regional towns, you see the next day they're in the pubs, they're happy, right? The world's looking on. There's the green shoots emerging in their fields. Things can change so quickly. Consumer confidence, I really like that. It's a good point. And just to touch on the thing you're talking about, politics, leadership is critical. Leadership can really change consumer confidence in a heartbeat. If you've got a good leader, good prime minister, good premier, good regulators who stand up and say and act and behave the right way, it can change things completely. Number 6, Simon.
Number 6 is wage growth. When we look at the last 3 decades of Australian real estate, without exception, the most prosperous period for Australian real estate history was sort of 2001 through to about 2006. Wage growth was roaring during that period of time. Here's some numbers that some people probably never would have heard of, others would have forgotten. If we break Australia down into the last 2 decades, in no particular order here, the decade just gone, Adelaide's median house price grew by 24%. The decade before that, it grew by 193%. Hobart grew by 232% in that decade. Sydney grew by 90% in that decade. In a year, it nearly doubled, which is a lot. But in that same decade, so we're talking up to 2009, Sydney was the weakest at 90%.
Yeah.
Brisbane's median house price tripled in 10 years. Wage growth is a really, really powerful thing. In this era that I'm talking about, Australia's most prosperous era in Australian real estate history, interest rates were roughly 9%. Today, they're a bit above 3%. So we're paying 3 times the cost of our debt back then, but yet property prices in some locations, in many locations, tripled within 10 years. That's what wage growth does.
And if you don't mind, Simon, I think we should share this. You just put a chart across the table here, changing median prices. Geez, I wish I started investing a decade before. Look at this thing, and I did it right in Sydney, right? And this is sort of the portfolio right across the country, 2009 to 2019. And if you looked at them in isolation, by and large, you'd be reasonably happy with them. But when you look at compared to the decade beforehand, Sydney's performed, and this shows me stability in Sydney, right? It doesn't fluctuate too much. But some of these other areas you've mentioned, like Hobart, Canberra, Brisbane and Adelaide in particular, they're firing all cylinders. And you're saying are you saying this directly correlates to the speed in which people are able to make more money through their jobs by getting pay rises?
Yeah, wage growth, I guess it's an outcome, but it's understanding what actually influences the outcome of wage growth. So in that era, we had, I guess, a lot of things that we haven't had in the last decade. We had government stability. Yeah. We've just gone through and we've had 6 prime ministers in 10 years in the last decade.
These are the Howard and Hawke years here, right?
Yeah. So we had, different sides of government there, but both had really, really long terms in government. They were generally positive people when they're fronting, the electorate. They were pro-economies. So economies were always expanding and wages grow on the back of that. And wages affect our mood. We were talking earlier about sentiment. So we're in a positive mood to transact in property, but it also affects our capacity, even with higher interest rates, our capacity to counteract the higher interest rates and transact in property.
Not to politicise this, but I'm very visual. Like This is when Howard came out of I'm pointing to a graph here right now. This sort of speed of wage growth is pretty much Howard coming out as Prime Minister and the GFC hitting place, and it's just been a downward spiral from there, really, in terms of wage growth.
Yeah, Australia is two completely contrasting decades. We will probably never see anything like we saw the decade ending the GFC.
Yeah.
The most lucrative period by a mile. What's important for investors is understand what happened in those years. And then learning from that to drill down and looking for those sort of similarities in locations today.
Just to pull in a number of different, because I'm looking at a bit of data here now, if you overlay wage growth over interest rate reductions, it largely mirrors it, doesn't it?
Wage growth, interest rates generally go up when wages are increasing, because the Reserve Bank, when wages are consistently going high, when we're spending lots of money because we've got not only more cash, but we've got more confidence.
They've got to try and ratchet it back a bit so they push interest rates up. Yeah,
exactly.
So everything correlates. This is interesting stuff. As you can see, I can be a bit of a data nerd as well, mate, much like you. So when I get into it. So good point. I was going to say, if you want to try and invest in more property, I'd try and ask for a pay rise, but probably not much luck these days, is there?
No. Which is why
2.2%, wage growth at the moment.
Yeah, so we have had wage growth, but not much. But that's why the Reserve Bank dropped interest rates 3 times in 5 months.
Yeah.
That's their contribution to it. They can't do everything, but that's their contribution to it.
And this is the role of the Reserve Bank in help determining the speed of change in Australia's sort of economic fortune. So that's good wage growth. Number 5, Simon.
So number 5 is key industries. I deliberately talk a lot about economics because it has an enormous impact on property markets. So things like, 2011, a lot of people might forget, but 8 out of 8 capital cities declined in 2011. In 2012, 5 out of 8 capital cities declined again. And in that period of time, our Federal Treasurer was a gentleman by the name of Wayne Swan. And just about every press conference he had, he would remind us we've got a 2-speed economy. Back then, we had the resources sector firing, and property markets that, I guess, benefited from the natural resources sector were doing wonderfully well. But our services sector was in the doldrums, and that's what he's referring to with the 2-speed economy. So, but of course, mining is just one industry. What's important for property investors is to understand with each location throughout Australia, what are the most important industries to its economy? And then try to form an educated view. What's the outlook for each of those industries? And that's going to give you, I guess, a good foundation to warrant whether it's worth drilling any further to consider investing there or not. Over the last sort of 4 or 5 years, we've deliberately followed money trails such as the tourism sector, such as the agricultural sector, such as the international student market, and parts of our manufacturing sector. And we continue to follow those main locations, not just capital cities, outside of our capital cities as well.
I've been waiting here for you to present me some numbers from regional towns, and here they are.
Yeah, so again, our most prosperous era, that you've got some locations there in all states, I think, 2002 to 2007, and what their median house price increased by in that period. And then the same locations, how they performed 2012 to 2017. So both chunks of 6 consecutive years, but very contrasting results. I'll let you share some of those numbers.
Well, you're looking at, and you mentioned it beforehand, you've travelled to a lot of Australia. You're both in regional and metropolitan towns. So 2002 to 2007. So this is the median price growth over that period. Sydney, 2002 to 2007. Sydney, 57%. Melbourne, 70%. Brisbane, 137%. Adelaide, 111%. Canberra, 128%. And Perth, 184%. And that sort of correlates in 6 years back to those big spikes when you look at this tale of 2 decades, right? But then you get into some of the regional towns and most listeners will know where these places are. Armidale, 126% increase. Wagga Wagga, 105%. Can you just call it Wagga?
Yeah,
you got to be a local to call it Wagga, or I can call it. Us out of town's got to call it Wagga Wagga. Bendigo, down in Victoria, 82%. Warrnambool, 86%. Cairns, 147%. Bundaberg, 170%. And it goes on down through Mount Gambier,
big
Albany,
numbers in 6 years.
They're big numbers, but they're pretty consistent. Like they're essentially in lockstep with the metropolitan markets. They're both of them. Yeah. But then when you get into 2012 to 2007, Sydney by and large a little bit more, 57%. Melbourne 53%. Brisbane 22% versus 137% a decade prior.
Yeah.
Canberra, 24% versus 128 a decade prior for the same period. Perth, and we know there's a lot of people hurting out of Perth, 9% median house price growth versus 184 for the same period a decade prior. Massive. And then some of your regional towns have slowed down quite a lot compared to...
Correct.
So you had to be investing in... If you started investing in 2002, you probably would have done all right.
You've done exceptionally well.
Yeah.
And I would argue we probably won't see that sort of rate of growth again.
And this goes down to these sort of key industry sectors. And you could... If we had 2002, 2007, mining boom.
Yeah.
And that sort of supported a lot of these regional places and the flow-on effect up and into the capital cities where the money flows. Perth, for example, 184%.
Yeah, but those regional locations, not many of those, if any, are actually mining towns.
True. They're very diversified in their economic base, though.
That's the key.
Interesting. Okay, number 4. We're going to go to a break beforehand. Hold on to your seat. We've got 4 more to go. I'm going to get Tom here to write down what he thinks number 1 is to see how good he is, and we can test it at the bottom. I'm going to write it as well, just as a bit of a pop quiz. Back in a moment.
We get it. You're here listening to the Smart Property Investment Show, and you're being interrupted by this ad. We value your ears just as much as your eyeballs, so we'll be quick. Join passionate property investors on Facebook today, and we'll fill your Facebook feed with useful tips and tools, plus free education from industry experts and a tribe of people who get it. Passionate property investors. Find us on Facebook now.
Welcome back, everyone, here with Propertyology Head of Research, Simon Pressley, chatting through the top 10 market influences. We've just done number 5, which is key industries. Again, if you're investing irrespective of whether it's a metropolitan or a regional area, diversity of industry, how people make their money in a whole bunch of different ways is a good fundamental if you're investing in property. Number 4, Simon, what do you got for us?
Sadly, I say this because I really don't like politicians. I really, no matter what side of the fence they're on.
I love politicians. They're great.
But number 4 is state governments.
Okay.
More so than federal governments. And here's why they have such an influence on property markets, whether they're likeable or not. Right throughout history, there are examples of when there is a government, no matter which side of the fence they're on, if they only just get elected, that in itself is the public, that saying we're not quite sure either side. And it's amazing how often when you've got any form of government in office that haven't got an overwhelming majority, how we see that in economic conditions, consumer confidence, wage growth, all the other stuff we were talking about earlier can be influenced by who's actually in the chair. So their likeability, let's face it, they're on our TV screen every day. They're in your ear every day through radio and podcasts and that sort of stuff. So if their dialogue and if their tone is positive, whether we seek it out or not, it affects us.
That's leadership, right?
Yeah.
We touched on it beforehand.
Are they good economic managers? The stuff we've been talking about earlier, a lot of that is economic related. So if the state government is a good economic manager, you'll have good economic conditions during their term in office, which is going to affect all those things we've been talking about earlier. If they're poor at that, generally property markets will perform that way. Sadly, my home state, I'm from Queensland for those who don't know, we are now in our 11th year where the Queensland unemployment rate has been above the national average.
It's because you're all lazy up that way. You sit on the beach all day and just drink rum and Forex, right? That's typically what happens. Isn't it what the rest of Australia thinks? Tell us at the head of the smart property investor. I know, I love Queenslanders.
Yeah, so what else does state governments influence? Land taxes. They affect, we've got rental legislation in most states and territories at the moment. That's state government, not federal government. They affect international relationships. We've got some good examples of, I'm showing my age here, but the Kennett era. Victoria was in the worst recession, arguably, of any state and territory in our history for quite a period of time there. And that changed really quickly under good leadership. New South Wales are going back 10 years or so ago, but I think New South Wales, what was it, like 6 premiers in about 8 or 9 years or something.
We went through them.
Shuffling the chairs.
Yeah.
And then you had a fellow, he's retired now, but a fellow called Mike Baird, who proved to be very popular.
It's very good.
It's no coincidence New South Wales economy went from being an also-ran, state economy to, for several years there was Australia's best perform economy. How did New South Wales property markets perform? Sydney did really well, and all of regional New South Wales did really well as well.
We only need to look, we're recording this from Sydney, you only need to look at the cranes in the sky here and the work going on. And, I don't want to get into the politics. My politics is largely irrelevant and I won't take a position on this, but, you've Gladys Berejiklian she's carried on from bed, and that sort of momentum that was started by him has continued, and we're seeing massive infrastructure development here right now. And, that's a product of a moment in time. It's a product of Sydney's spot in the world, but at least we're capitalising on it here. The point around politics and when Australia votes or whether a state votes, you need a strong majority, because if you don't and you have a very split parliament, you put the power in the hands of the marginal minorities who, the way they see the world and some of the political positions that they represent, largely don't mean anything to anyone else and probably only influence a handful of people. But you put the power of the vote in the hands of those people in Parliament, you start to lose your way a little bit. And you see it federally as well. Yeah.
So my point is not people should vote who they're comfortable voting with, obviously. This is not about who to vote for. This is about understanding the role the state government has and its importance of managing an economy well and the various policies that can affect property. All these things have a direct knock-on effect to how property markets perform.
And back to housing affordability and all those issues, that's dictated by state government, right? They put the incentives in place. You think how state governments make their money. They get it through, stamp duty, land tax and payroll tax, right? They're the three biggest drivers of government coffers that allows them to spend. Now, in Sydney or in Melbourne, for example, if business productivity is high and people are making money, they get a few more bucks out of it. In payroll tax, people get employed more. That impacts on wage growth. Everything is so interconnected and interlinked that, again, to the point I made at the start of the podcast, you just don't know. Like, as a property investor, you can't control a lot of this stuff. You can just control your attitude towards or how familiar you are with it.
Absolutely.
That's the key.
Absolutely.
Okay. Point number 3.
Point number 3 is related to what we've just been talking about, job creation. Wherever there is a demand for more jobs, there will be demand for more shelter. As a property investor, you are investing in shelter. Don't focus on the bricks and mortar, how it looks. You need to see property as a commodity when you're an investor. It's a financial instrument. Think of it more like how a share investor would invest. So when more jobs are created, you have an improved mood, you have improved wages. The location may attract people from somewhere else where they don't have a job to relocate there. So, we talked earlier about internal migration. I've given you an example there, a graphic where you can see change in job volumes and how that directly translate to property markets. Phil's looking at the Hobart, 2 booms that Hobart...
Well, they added 2 more jobs in Hobart, did they, during that period of time?
Did you know, just on Hobart, did you know that Hobart's pretty much the same population size as Wollongong, Geelong and Newcastle?
Is it? It's a considerable place then, yeah.
Always has been.
It's a great place, Hobart. I love Hobart.
Let me just say, let me remind you, it's been officially Australia's best performed property market from a capital growth and rental growth over the last 5 years and is still roaring.
Yeah, but the reason why is because it was flat for a long period of time. It just caught up, right?
As every other location.
Yeah, this is the nature of property cycles, right?
Absolutely.
They're up and down, left and right. So how do you know about job volume? If you're considering an investable location, how do you find out what the job volume is in those areas?
So the ABS, it's a minefield of data, but they can show you how many jobs as a number are in each location in Australia, but that's really not going to be useful to someone.
Yeah.
I guess what I'm trying to explain to people is understanding that the job growth, that happens first before the property growth. That is the leading indicator. An unemployment rate is useless to a property investor. If you think I'm just going to go and try and find what's got the lowest unemployment rate in all of Australia and that's where the hotspots are, that's not going to be helpful. It's understanding all the decisions that are happening behind the scenes, whether it's city councils, whether it's state governments, whether it's the big businesses with different industry sectors, those decisions that they make, what jobs will it create? That's the stuff that literally all day my head's in. That is the leading indicator for where is the next Hobart, where is the next Ballarat or Launceston. It's understanding those leading indicators.
And interesting because job volume, so I guess new jobs, and you want it to be increasing, is so intrinsically connected with all the other points that we've made here, because job volume is dictated by exchange rates. Is it more favourable time for people to be travelling in Australia for whatever reason, therefore tourism is booming? Lifestyle, consumer confidence highly connected with it. And also leadership from government, right? This dictates if you've got a good government and the good mechanisms of government in place to support job creation, that's what it's all about.
Yeah, definitely.
Nice. All right, number 2, Simon, we're nearly there.
Number 2 is the construction industry. Can have a positive and a negative effect in a big way on property markets. The construction industry is one of Australia's biggest industry sectors from an employment size. Right? So when the construction industry is expanding, That's job creation. We've been talking about that. But it's also what they're doing. It's not just a job. It's a job to do what? In the construction sector's case, is it a job to construct an infrastructure project, or is it a job to construct a house and land estate or a high-rise block of apartments? Generally speaking, when you've got a healthy local construction sector, you've got a healthy local economy and thereby a healthy local property market. But if it gets overstimulated, if during a really strong economic period the construction sector gets too excited and too stimulated, the end product of their work is lots and lots and lots of dwellings. And there are all sorts of, test cases around Australia where there's been periods during strong economic times that they've just built way too many, and that has been the direct cause of a significant downturn. Sydney and Melbourne's downturn 2018 and 19 was caused by an overzealous construction era during their strong economic times that resulted in a lot more supply than their strong growing population required.
So this ebbs and flows. Who's responsible for getting the speed of growth in approvals right versus the needs of people for shelter?
You'd think that there'd be a formula where someone could say, we're not going to approve that because we've got enough and we don't want to cause some harm down the track. But the reality is city councils who I talk to regularly, they don't have that power. Their responsibility is to respect whatever zoning conditions are in place. And if a developer hits them up with an application and it fits within that parameter, it's approved. Now, it may well be that it shouldn't be approved because there's more there than what the public will need in future years, but that's not the city council's role to knock it back.
So this whole construction industry, and I think when you talk about construction industry, people think about the guys and girls on building sites building stuff, but it's a massive industry. It's banking. It's sort of finance. It's investment banking. It's, the whole mortgage industry connected in with that. It's a real estate sector connected. That's all part of the construction industry, right? It's all part of the ecosystem.
Yeah.
Tough to control.
We've also seen a few things in the last decade related to the construction industry. It's not just the volume of what they build. It's the quality of what they build.
Yeah.
And, all sorts of – we're going to hear about this for decades about the, mascot towers, and there are, sadly, thousands and thousands of buildings in our big cities, some that just haven't been exposed with these major defects. So it's the quality of what they build, but it's also the style of what they build. A decade ago, Sydney still had a lot of apartments back then. Melbourne and Brisbane had bugger all apartments. An apartment back then was probably a 4 or 5 story thing.
True. In
the last decade, what we've seen is, it feels like almost overnight, these big towers have popped up. So we're very immature as a nation with apartments, and that's been reflected in locations where broader house prices might have performed well. My home city in Brisbane, a typical apartment today is worth less than what it was 10 years ago.
Well, this is it. There's a high connectivity of the globalisation of Australia, particularly on the eastern seaboard, of attracting people from all around the world to come and live here, and the changing nature of how they want to live. Hence the reason why we're seeing these buildings going up to the sky.
Yeah.
It's a very changing. I actually, it's encouraging. I spoke with a project marketer today. So a project marketer, typically when they build a new block, a developer gets a project marketer in to go and sell all the properties, whether it's off the plan or new builds. And he said that investors, whether they're owner-occupiers or actual property investors, now the actual developer, who the developer is and the reputation is probably one of the most primary things they're looking at when considering a new purchase. So
right.
I think we're getting a bit more sophisticated as
we
investors.
Have to. There's a lot of people that have been let down out there, a lot of, whether they're investors, first-time buyers, upsizers, downsizers who have been let down because of poor quality control.
Here we are, number one. And now you put it in front of me, I say, absolutely, that's what it's got to be, right? It's access to. What is it, number one?
Number one,
Simon?
and I didn't even have to think about this, it's credit policy. We have spoken during this discussion about our most lucrative period, and we've spoken about officially the worst period in Australian real estate history is an 18-month period that ended in middle of 2019. That's what the official data says. What was credit like in the strongest era and the weakest era? Well, in the strongest era, you might remember that it was possible to get not only a 100% loan, but there were people who could get 106%. I remember it fondly because in a former life, my background's banking and finance. So you could literally, as a first home buyer, borrow 100% of the purchase price plus add your stamps to it. We had things called low doc loans, so people could just sign a piece of paper and saying, this is what I earn, trust me. Interest rates were a lot higher, So you notice interest rates are not on my list of 10 biggest influences.
Yeah.
That's not saying that they don't have an influence, but there are other things that have a bigger influence. And credit policy certainly is that. So if you cannot buy the debt, you cannot buy the asset.
Looking at the graph here, and I'll try and paint a picture for you. It's got medium house prices, so 30 years from 97 to where we are today. And it's going up, right, as property does. And then overlaid with that is residential credit approval, so mortgages being approved by banks. And it's gone up and down a little bit, but it absolutely falls off a cliff in probably about December
17, yep.
Yeah, started 2018 from 60,000 approvals annually, nationally, to 10,000 in a matter of a year and a half.
And it literally is a cliff. Now,
it's a huge cliff.
So that has directly affected property markets right throughout Australia. But it's more important to property markets is the broader economy. So every second day there'll be some kind of economic data that the economists of the world talk about, the latest building approvals, the latest retail trade, whatever it is, right? Those numbers the trend has been negative for the last 12 months. That is APRA. It's been reported as our economy has been struggling, but there are two forms of money. It is what we earn and it is what we borrow. There are only two taps. And in this nation, we had one of those taps barely dripping for a period of 2 years. In the end there, hardly anybody could get a loan. So when that happens, if they can't get the loan, they do not spend. So this is not a property market story. This is a bigger picture economic story. So this is why we're quite bullish about our economy going forward, because finally APRA put their hand up last year and said we went too far. I would still like to see them relax it a bit further than what they have. But good quality.
They've dialed it back a bit now.
They have. So money is filtering through the economy. So the negative data that we're hearing about the economy, give it some time. And not many of us are patient, especially myself. But as 2020 unfolds and we get into 2021, we'll start to see some much better economic conditions and really strong property markets.
So maybe you can provide me these numbers, Simon. You wouldn't be able to do it straight off your head, but this huge decrease from 60,000 to 10,000 approvals over a period of a year and a half or so, 2 years. Have you got that granular owner-occupied investment?
Investment is still at an all-time record low. Yeah,
I imagine, because that must be a big driver of it. And when you look at this graph in terms of medium house prices, what's happened over the last sort of 2 and a bit years, it's happened before, in 10 to 12, and it happened again sort of, 4 to 6, 2004 to 2006. Do you think that has bottomed out now? It's only going to go up from where it is?
Definitely. Because the powers that be have recognised the unintended consequences that myself and others spoke about during the 4 years that APRA progressively tightened credit. And we kept saying, you're going about this the wrong way, there will be unintended consequences. And that's largely in the form of the economy. So they've recognised that.
Yeah. But they hit everyone in so many different ways, right? Yeah. Like they said, shape your investment lending. You can't grow your investment lending too much. Service loans at a particular amount. So
but it wasn't just investors, it was anyone who wanted a loan.
Yeah, I know, but driven by, that was targeting investors by
Initially
and large.
It was. Yeah.
Well, the perception that investors were pushing the prices of property up too far, so we need to stop investors from investing in property, right?
Yeah.
It's a bit of xenophobia around there as well, by memory. These foreign investors coming and buying up all the property. I'm happy we're not there where we were back then, because some of the rhetoric coming out was just
at a more granular level, Phil, how this shows up is for everyone who buys an investment property, that's one extra property added to the rental stock. Now, when we get our head out of the capital cities for a minute, right throughout, I'm not saying every location, but dozens and dozens of locations in Australia, they have some seriously tight vacancy rates. And so when there's several years where there's little investing in a location, rents get tighter and tighter. We've already seen rents increase quite significantly in some locations, and some of those property markets are really starting to fire on all cylinders.
And there's a point here, and just sort of when you start getting a whole bunch of data in front of you, you can start overlaying it and start painting a picture. Population growth's come off over the last couple of years, peaking sort of circa 110,000 in 2017. It's down to, I reckon, probably Sydney. It's probably going to sit somewhere around 90,000 this year, I would imagine, 95,000. Now, it's come back sort of 10, 15,000, but if you consider, if you go back a decade, you're only looking at your sort of 60,000, right? So the speed of population growth is increasing. Going back to your base proposition that as a property investor, you're investing in shelter for people. The more people, the more shelter.
Yes, but it's more complicated than that. You notice population growth is not on my list of 10 biggest influences.
No, it's not.
Again, Australia's most prosperous years, that 6-year period we were talking about earlier, the national population growth was less than 300,000 in each of those calendar years. I'll say it again, less than 300,000 in each of those years. The last decade, most years were in excess of 400,000. There were some years they were more than 450,000. I've invested in a place called Burnie. Some people probably never would have heard of it. 5 years ago.
Top of Tasmania?
Yeah. 5 years ago. I'm not invested there now, right? But 5 years ago, I invested in a place called Burnie. Its population is less today than 5 years ago. Burnie's median house price has grown by 30% over the 5 years that I've owned that property. My home city of Brisbane has grown by half of that. And its population has grown by hundreds of thousands over that period of time. So there are literally thousands of case studies that we could throw out there to show you that population growth is by no means the biggest influence on property prices.
Well, I think with
far from it.
So you're okay if we share all these charts and graphs on smartpropertyinvestment.com.au?
Absolutely.
Yeah, okay, they're good. I'm going to keep these and make it part of my property data arsenal so I can start talking about it more. All you've done, Simon, is confused me even more than what it was beforehand.
Well, and that's the thing. I would argue that there's nothing more complicated on the planet than trying to figure out property markets.
Yes. It just goes to show, like, you think you can draw a parallel between something, you go, well, that's not right because of this reason. So, you know, what I would conclude, if I had to make one conclusion with this, is that if you look at property price growth after the last 30 years, it's a good asset class.
Absolutely. Yep.
So let's just agree with that, right?
Prices go down, but downturns usually last a couple of years. They can be nasty. They can go flat for several years. And when they're strong, they're really strong. But over the course of a generation, probably be worth a lot more at the end of that life cycle than at the start of it.
Very good. We'll share all this stuff and quite keen on anyone's commentary around this. We'll share it and you can get in touch with us. If you've got any questions about this, and I'm sure you do, some of the stuff we've spoken about is pretty sort of, you know, common sense. Some of it's a little bit more sophisticated. So if you've got any questions at all around any of these factors which are influencing the directions of property in Australia, get in touch with these sort of top 10 market influencers, editor at smartpropertyinvestment.com.au. Simon will be happy to answer any questions you've got around it. I'm sure everyone's scratching their heads like I am. I think we've done pretty well. Did you pick that, Tom? No, he's shaking his head. I always knew it was going to be credit approval. I sort of had it framed as in how easy it is to get a mortgage is the thing. Property's a game of finance, right?
Largely, yeah. Yeah.
It's good.
Finance en masse creates property price growth.
Final word, Simon. We've been at this for 55 minutes. Pretty heavy, pretty deep.
So most of those are macro things, right?
Yeah.
So some of those things, they will just happen and there's nothing you can research, there's nothing you can do about it, but that will, positively or negative, it will affect the rate of growth. The things that are most important for a property investor to focus on, that is going to vary from location to location, the more granular stuff is the economic conditions. Look, I would spend dozens and dozens of hours every week researching a whole heap of stuff. But what we always spend most of our time on is leading indicators for economic conditions. That is not in data. I agree 100% with what you said at the start of this podcast. Data is so valuable and it's factual, it's evidence-based, but not everything is in data.
Is there a machine that, right now I'm holding up a stack of coloured printed graphs and charts with more data in there. Is there a machine that I can throw all this into and it'll go beep, 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 beep?
No.
Buy here, or is that a buyer's agent?
But believe me, we have tried and played around with all sorts of formulas and algorithms and all that sort of stuff. They're very short term.
Yeah.
You can put them in there and there's a degree of accuracy in terms of, you know, what might happen in the next year or so. That's useless for a property investor though. No one buys a property and holds it for 12 months. You go broke doing that.
Let's keep at it. Thanks for coming down, Simon.
My
I do
pleasure.
enjoy it. And you go back to sunny old Queensland. It's only going half the speed of the rest of Australia, but I'm highly invested in Brisbane in particular. Doing well. I've got property up there. I'm sitting around. I hear it's the year for Brisbane.
You haven't heard that from me, but there will be plenty of people that will try to convince you that. If anyone wants Brisbane to grow, mate, it's me.
Yeah.
It is my home city, and like you, I've invested there pretty heavily. But what I've learned in real estate is personal bias and wishful thinking. All it is a recipe for frustration. Yeah. I promise you, when I think the signs, tangible signs are there for Brisbane to go nuts, I'll come on your show and share it with you.
Okay. Well, maybe if I keep talking about it, maybe I can change consumer confidence around Brisbane. Thanks so much, mate, for making the effort to come down. And we'll get, and Simon's podcast, by the way, really popular. So if you like this stuff, let's get these questions coming through. We can even just do a Q&A episode with Simon. If you want to challenge him, no worries. If you want to agree with him, no worries. We can have that discussion. Email the team, editor at smartpropertyinvestment.com.au. Or what you can also do is click click that button where you're listening to this right now on smartpropertyinvestment.com.au that says start recording, record your message. We'll get them answered on air. And I hope you enjoy that. Remember, social media, if that's where you like to get your stuff, search Smart Property HQ. You can send us a direct message there. And please, big favour for me, if you enjoy doing what we're doing right here, please keep those reviews coming wherever you listen to it, probably mainly on iTunes. The team here get a real kick out of it. There's a lot of preparation goes into these podcasts, and it's just a lot more than me just behind the microphone having a bit of a chin wag with you guys. So they get a kick out of it. So if you can do that, I'd really appreciate it. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.